Hi, everyone. Welcome to the second ever Carson's The Glass Half Full. Ryan and Sonu here as always. Sonu, there's a lot in the news, and obviously we're going to focus on what really matters. Go ahead with the title this week, Sonu.
Yeah, how much does Iran matter? And by that, we mean how much do the hostilities and everything that's happening in the Strait of Hormuz. By now, I am sure you would have heard of that phrase, the Strait of Hormuz, and how it is a choke point for the flow of global oil.
Yes, I mean, a year or so ago, we were talking about that, Sonu. You were, most people didn't quite know, and now we all know. But we are fully aware of just the devastation and the lives lost and so many issues, obviously, that are happening around the globe and in the Middle East. But our job as a steward of assets is to focus on your investments and the market and the economy and all those things. That's what we're going to do every single week here at the Glass Half Full. So let's just start high level, Sonu. Is oil flowing through the Strait of Hormuz yet, or is it stopped again? What's it looking like?
Maybe just a little bit of sneaking through, maybe a few tankers taking oil to China. That's about it, right? So just backing up to give you all a big picture of what this, means and how much the straitjacket of the Strait of Hormuz, pun intended, actually means, right? So if you think about the world economy, it mostly runs on oil. Pretty much oil and gas, right?
Yes.
You need LNG and things like that. Even for making things like fertilizers and chips and, semiconductor chips, all that. You need helium, for example, to make semiconductor chips. And a lot of that comes from the Middle East. So if you say, look, think about global oil demand. The world needs about 100 million barrels per day of oil. Okay. The Strait of Hormuz, takes about 20% of that flows through the Strait of Hormuz. So about 20 million barrels a day. We don't have that right now.
Right.
That's a problem. You think about the global economic engine, 20% of it cannot run because you have the shortage. And it is a physical shortage. It's not a financial market crisis or anything like that. It could translate to the one later. So far, it hasn't. That's the good news. But you think about this 20 million barrels of oil that's missing from the market. So what happens? Maybe a few ships are sneaking through with their radars off, their lights off, their communications equipment off. That's 1 million. You still are short about 19 million barrels. Saudi Arabia can reroute oil from its, loading docks and ports on the Persian Gulf to the other side. It's a vast desert, but they have pipelines. But that takes you, they have capacity for maybe about 7 million barrels. So you still have a shortage. Now you still have a shortage about 12, 13 million barrels per day, right? And that's why yesterday the International Energy Administration, EIA, said all its member countries, this includes the US, Japan, Korea, Canada, and a lot of European economies, they're going to release 400 million barrels of oil. Now, that's not obviously one day. It's over a period of time. We don't know how much time. The US did come and say 172 million barrels of oil will be released from the Strategic Petroleum Reserve.
How many do we have? That's about half. Is that about half our reserve, or how much is that?
Yeah, it's about half our reserve. But that's going. The important part is not how much; it's how quickly it flows out of it.
Got it.
Because the world needs 20 million barrels per day. With Saudi Arabia's rerouting capacity, we probably still have a shortage about 13 million barrels. But with the U.S. releasing 172 million barrels in 120 days, that translates to about, let's say, about 1.5 million barrels per day. Let's say other countries join the action there. Let's say you get to about 3 million barrels per day. 3 plus 7 rerouted. You're still at 10. You're still at 50% shortage, right? That is still a big shortage. That is why everyone's worried about oil. That is why oil prices have gone up.
And, so again, let's just rewind for a second. You and I do lots of morning calls with our Carson advisors and talk to clients often. And I had a running joke. Crude oil was like always $60 a barrel. It felt like late last year, early this year. Every time you look, like gold would be going up. All these other commodities were going higher. Yet crude was pretty much $60 a barrel, like all the time. And then it soared up to 120, when everything started. Then it came back down and it crashed. And the time we're doing this, it's ballpark mid 90s per barrel. Trust me, when everyone listens to this, it might be different. But I guess the bottom line, Sonu, to everyone listening to this latest Glass Half Full, does this mean when we go to the tank, like say this summer, we're going to be paying $4 or $5 a barrel, or not a barrel? Sorry, that'd be cheap. Actually, $4 or $5 a barrel would be cheap. $4 or $5 a gallon. How much is going to impact the consumers out there?
Look, just a month ago, gasoline prices, the nationwide average was less than $2.90 a gallon. The nationwide average today is closer to $3.60. So that's a big jump. right? Will it stay there? Really depends on how long this conflict goes on for. The fact that the U.S. is starting to release barrels of oil from its strategic petroleum reserve tells you that this could go on longer, right? If the U.S. government thought this is going to end next week, they probably wouldn't be releasing oil from the strategic petroleum reserve. That tells you that there's a bit of a problem here. Then the other side is, will we get to $4 a gallon? We could. Will we get to $5? I doubt it. But, I've been wrong before, so don't take my word for it. I don't think we get to $5 a barrel. Before that, I think, look, this is a global shortage, right? In the US, we have a lot of oil, so I don't think we see shortages. How what the impact will be through higher prices. Same thing in Europe, right? Because we can afford higher prices in a sense. Whereas in the rest of the world, there'll be outright shortages, including for things like LNG. That's why places like Bangladesh, for example, even parts of India said, you know what, workers stay at home. Don't come to the office,
right?
Because that requires usage of oil. So there is a lot happening already on the demand side.
So when we say LNG, that's liquefied natural gas. The United States produces just as much as anyone, if not more. And we are now an exporter, right, of petroleum and crude. So that, this time is different from that angle versus
and that's why
crises.
We are a net exporter of petroleum products now. That wasn't the case.
No,
we're in a good position, which is why I don't think we'll get to shortages here. Right.
Yeah.
But at the same time, our refineries can process only a certain type of crude oil. So along the East Coast, we import a lot of oil because we don't produce that type of oil. Canada and Venezuela, for example, can give us oil, but they give you something that is really tar-like sludge. We need something much lighter than that.
Right.
In the U.S., in shale, we get a lot of oil that is more like, what we call light sweet crude.
I was going to make a joke. It doesn't taste sweet, but it is called light sweet.
I haven't tasted it.
Don't go that route. Yeah,
exactly. So we do import. That is why we import a lot of oil, despite being the world's largest producer of oil, because our refineries need a certain type of oil.
We have a large dynamic country, and we have a lot of needs, and that's where all this is coming. So let's kind of put a bow on things. Let's just high picture from a market's point of view. Listen, we understand the drama, the headline risk, the terrible things that are happening overseas, the volatility we're seeing in our oil markets, the volatility we're seeing in our equity markets, and even more so equity markets around the globe. We've actually seen, Sonu, since all this started, U.S. has been about the strongest market. Now, yet we're down a little bit, but actually a lot of other countries are down more. So it's like maybe a little bit of a safety trade to the United States. Maybe the economy slows down a little bit. Listen, well, that's not our base case, but what happens historically, you have investors reach for growth when the economy slows down. We are a growth heavy, kind of tech-led country, right? So tech has actually done a little bit better. Remember that software big sell-off we had, a month ago or so? We talked a lot about that. We've seen strength from those areas, but I'll put it like this, Sonu, let you finish it up. The time we're doing this, the Dow Jones Industrial Average is up 10 months in a row. All right. 10 months in a row is one of the longest win streaks in the history of the Dow. It started way back in 1896. We're probably due for some volatility. Heaven forbid we're due for a down month or two. I mean, that happens, right? And again, we're right in that spot where this headline risk is there. The concerns are there. We're not minimizing them at all, but we still think we're going to get through this. We still think we're in a bull market being led by higher earnings, being led by higher profits, being led by higher, what's what I'm looking for, productivity, right? We still have probably a dovish Fed. We'll talk way more about the Fed soon enough. We'll get back to that stuff. But there are still a lot of tailwinds to this bull market. Clearly what's happened in the Middle East has put a pause in that. But again, we've had a heck of a run, so maybe the market was due for a pause. Sonu, how do you want to finish up the second ever glass half full?
So you talk about the equity part, equity side of the portfolio. I'll talk about the other side of it, the diversifier side of it.
Yeah.
Right. We've been talking about this for a few years, that we are in a regime, we are in a period with more inflation volatility. That means it could have periods when inflation spikes. It comes back down, but it's unpredictable. And that's a period when bonds don't diversify stocks as well as they historically have. When usually you expect bonds to zig when stocks are zagging. We don't expect that when inflation is volatile, when inflation's surging. That's why you want to diversify your diversifiers, have things like other commodities in your portfolio that can do well during periods like this. Same thing with maybe, the metals, for example, gold, for example, may be a better diversifier than bonds. You're not saying that's the only thing you should own, but diversifying your diversifiers is probably a good way to go right now.
Yeah, well said. I mean, keep this simple, right? Interest rates go up, bond prices usually don't do as well, and vice versa. Since all this started in the Middle East, a week and a half or so ago, almost 2 weeks ago, yields have gone higher. So bonds have not really given you the diversification that you would probably have preferred. But again, there's other areas that you can diversify your portfolio, as we've talked a lot about over the last several years. So with all of that, again, a shout out to David Smolar, our producer, for helping us all these podcasts and all these videos and getting us to the new series that we're doing here, the Glass Half Full. And yeah, I guess, well, who knows what we're going to talk about next week, Sonu? Let's hope we have some good news, but we'll see. But if we don't, we're going to talk about it either way. So everyone, again, this was your latest, I almost said Carson's Take 5. See that? We're so used to saying that. You know what I'm getting at, because we've done that a lot. The Glass Half Full. How much does Iran matter? We'll see you by next week. Take care. Thank you.